This is Bobby Walsh at the Connecticut Institute of Finance. Today I'd like to talk a little bit about how different people analyze stocks for their value to compare one stock versus another. You know, it's two fundamental ways, or now I'm using double words. There's two ways that traditionally we can value the stock market or individual stocks. The first way is a fundamental analysis. Okay, the second way is a technical analysis. Now, we'll start with the technical analysis first. A technical analysis is really the study, for a large extent, of crowd mentality. It's a study of price, it's a study of volume, and it's a study of movement. Okay? The idea behind this is you don't really care what the company does. All right? What you're looking at is price movements, volume, and also momentum on the stock to see and expect where the stock market goes. Now, in my opinion, technical analysis only works because people use it. Okay? It's a self-fulfilling prophecy. One of the simpler ways with the technical analysis is you'll hear people explaining levels of resistance and levels of support. Now, sounds just like what it says. A level of support, okay, is where if a stock goes down to this level, enough people will think it's cheap enough at that level that people will buy it. It will tend to bounce off that level and then go higher. A level of resistance, if a stock goes up to a certain price, okay, and hits that price, it will tend to hit that price and people will say, well, I think it's too expensive here, and start to sell it, and then the price will come off. Now, this goes back into the history of the stock, and it kind of has a common sense approach to it if you think about it. This is the most simplistic area of this to do. So let's say you as an individual, you bought a stock at $20 a share, okay, and you're owning the stock for a little while, and it went all the way up to $40 a share, okay? And then it started going back down to $28 a share, and you're not very happy. But you still like the company, and you're going to own it, but then it goes back up to $40 a share. Well, you know last time it went to $40 a share, it went back down, so you really are kind of nervous about it. So what you do is, well, if it gets to $40 a share, I'm going to sell it. So you sell it at $40. And you and everybody else does the same thing. So because now it gets to $40 a share and everybody sells it, it's a self-fulfilling prophecy, because if everybody's selling and nobody's really buying, what happens to the price? It goes back down again. A level of support, all right, would be just the opposite. Now, you originally bought the stock, in our example, at $20 a share. So now the stock goes from, $28, you sold it at $40, and you're not really paying attention to it. A year goes by, and you're looking at it, and no real news came out, but the stock is back down to $20 a share. You're like, wow, last time I bought this stock at $20 a share, I doubled my money. Well, you and a lot of other people. So now it hits $20 a share, and you say, well, I think it's a good idea to buy it again. Everybody buys it, and it tends to go up. Now, these are exaggerated examples, but conceptually, that's where a price of resistance and a level of resistance and a level of support kind of come from. There are historic levels in the stock market where things have bounced off of it. Now, also the idea behind this, if you have a level of resistance, that high side that you go up to, and you break through that level of resistance, then the argument is the stock is even going to go much higher. Okay? Or if you have a level of support and you break through that level of support, it's going to go down lower to the next level that it actually went down to, or the next level of support. And there's people who make their whole career out of watching these things and studying curves on them, head and shoulders effects. And it gets very, very complicated. They also look at the volume of it. Obviously, if a stock is rising on a lot of volume, that shows there's a lot of people buying it, a lot of interest. If it's rising on a little volume, well, maybe it's kind of a head fake and we shouldn't be as concerned, and maybe it's really not a price point we want to be considered. So people track these, and this is what we call technical analysis. And there are courses taught on this. It is very, very, it's followed, and millions of people work on this all the time and put a lot of effort and energy into it. We use technical support here at the Connecticut Institute of Finance to look at levels of entry into a position or levels of exit out of a position. But we kind of lean on the other side of fundamental analysis. Now, on a fundamental analysis, you believe that stocks can be, for any period of time, unfairly priced or not efficiently priced. Okay? You don't believe in that random walk down Wall Street, that all information is into the stock market at any given time. So for a stock like that, we're looking at stuff that has value, and we don't think that the company is priced correctly for what it's doing. So a couple things that you want to look at with fundamental analysis. The first thing you want to look at is the company itself. What does it do? All right, is it have a secure position? Is there like somehow either a technical or a physical or an economic or a regional moat around it that protects it maybe from competitors? That would be an interesting company to own, because if nobody else can really compete with it and they have a lot of control over price, right, that company might be able to do well if what they have is actually in demand. We also want to look at the leadership of the company. Are there really talented, smart people running the company? Have they been successful before? Do they seem to have their act together? Are they very, very, out there trying to make the company do well and taking care of the stockholders? Some companies really, really try to help the stockholder and give the stockholders the most returns that they possibly can, and other companies maybe not so much. So you want to kind of look at that to figure out where it is. We also want to look at how the company's, what the company's earning, how the company's doing versus its price. Now, this is where it gets kind of crazy, and you really have to look at it. There are many, many companies out there that I love. I think they're wonderful companies and they do a great job. But I might not like the stock price because they could be either fully priced or even overly priced. So even though the company's a great company, we'll say the best company in the world, for where it's being valued right now, it's not a good buy. It's overly priced. Or the opposite, I could hate a company. I could say, well, I don't really think this company is all that great. I don't think they're really doing all that well. But for where it's priced right now, okay, it's silly. It shouldn't belong there. So you have to basically look at the price versus actually what the company does and its value to see if the price is representative. Now, one of the simplest ways we do that is something called a PE ratio, okay? It's called price over earnings. Now, sounds complicated. Wall Street loves jargon, all right, but it's really, really very easy if you think about it. PE is the price of a stock. So let's say we have a stock that's at $100, okay? That's what it costs. And the stock makes, all right, the company makes $10 per share. That's its earnings. Well, 100 divided by 10 would be a PE ratio of 10. Pretty inexpensive. But let's say the stock was only making $2.50 a share, and it cost $100. Well, now 100 divided by $2.50 would be a PE ratio of 40. Kind of expensive. So it's a way that we can compare one stock to another to see if it's expensive or not expensive. Because if you have a stock that's at $10 a share, but it's only paying you 10 cents, well, gee, that's 100 to 1 PE ratio. That's not very good. Well, you might say, well, $100, a company that says $100 a share is more expensive, but not according to its PE ratio if it's paying you $10 a share, because then that stock is at a PE ratio of 10, which is much cheaper than, obviously, 100. Now, I'm exaggerating this to make my point, but you want basically the lowest PE that you can get, all right, on a company that you're getting paid for the price of the stock for its earnings. But then we get a little bit more complicated when we look at PE ratios, because not all companies are the same. Some companies have relatively high PE ratios, but maybe that's all they're going to do. In other words, their price is relatively low and their earnings are pretty high, and maybe even they pay a great dividend, but they have like no growth. Okay, so the PE ratio is relatively high, but the company is not a growth type company. Well, what type of company would possibly be not a growth type company? Coal. Probably not a growth industry forever. Okay, I mean, sooner or later we're probably going to get rid of coal, all right, and not use it anymore. Another example historically is cigarette companies. Not relatively decent PE ratios, but your cigarette companies are never going to go up 20-25% in any given year. They're cash cows. They use their cash to buy back stock, they pay their great dividends, and people use it almost as a bond alternative, okay? But the idea behind it is, bond alternative would be a bad use of terms, but I would say more as an income alternative. So there's companies out there that if you just compare PE ratio, maybe it doesn't tell you the whole story, because there's a big difference between, we'll say, a company like the old Ma Bell utility type company that maybe has a relatively decent or low PE ratio versus something like maybe an Amazon.com that has a relatively high PE ratio, okay, which you say, well, that company's expensive, but you have to consider the next part of this, which is growth. This is another way to value the company. Okay, is a way we can get into it a little bit more, is we take the PE ratio, again, using my example, a company is basically making $100, is cost $100, it makes $10 a share, the PE ratio is 10. But let's say the growth rate, or the expected growth rate of the company is 10%. Well, now it's paying you 10%, it's growing at 10%, so we do something called the PEG ratio. It's PE over the growth. So we have a PE ratio 100 over 10, which is 10, over 10, that would be a PEG ratio of 1. Anything between under 1 is, as a rule of thumb, considered relatively inexpensive. Anything between 1 and 2, okay, is kind of like fairly priced. Anything over 2 is usually considered, as far as the PEG ratio go, to be a little more expensive. Now, none of these ratios are all-inclusive. None of these ratios will solve all your problems, but it's just another way that we can value different stocks and talk intelligently about it, of like, do we want to be in this company or do we want to be in this company, when the companies do two different things, the value of the stocks are at two different prices, and the growth rates are always different. So it gives you a way to value apples to oranges and come up with an idea of the actual value of the underlying instrument. And there's many, many other ways to do this. But this is more of a fundamental analysis. We look at the value of the company. And the idea of a fundamental analysis is that you can find stuff that hasn't been priced correctly, that's been overpriced, that you actually could short, or is underpriced that you want to buy because there's value in that, and we expect sooner or later people to realize the value and that company to come up to a fair level. So these are the ways that we look at the stock market, all right, to try to figure out where we are. Now, P ratios, right now, if you look at the market, the P ratio of the S&P 500, for example, a couple of weeks ago, as November 25th, was around 24. Historically, that's, kind of up there. That's really pricey. The mean average is roughly about 15.63. The median average is 14.64. Now, the low average, which a long time ago, December of 1917, all right, was actually 5.31. And some of you out there is going to be old enough to remember this, all right? The high was basically May of 2009, when it was at 123.73. That was the dot-com stuff. So that's a big range, right? But right now, usually the P ratio of the S&P 500, when it's at 12, 13, is considered relatively cheap. And when it's at basically 23, 24, 25, it's actually considered a little expensive. But then you have to weigh into the fact, is do we expect earnings in the future to grow? Because even though the P might be a little high versus the earnings today, what do we expect the earnings next quarter to be, or the following quarter to be? And is it going to grow enough to actually get that PE ratio down, or that PEG ratio where it's supposed to be? Complicated stuff, a lot involved. But again, this is how we actually value stocks, all right, individual stocks. Next time we have a conversation, we're going to talk about bonds. How do you actually value bonds? Now, when we do that, it's totally different in many ways, but includes a lot of fundamental analysis on the actual value of the company, okay, and also the value of where things are and interest rates in general. This is Bobby Walsh of the Connecticut Institute of Finance. This is just a small little idea of what goes into evaluating different stocks out there. What I'd like to do, though, if you have a portfolio, if you'd like to talk about it, use this as an idea to do some of your own research. Come in and talk to us. We'd love to sit down with you, go over your portfolio, see where things are priced, see where things are actually valued, see how your portfolio is valued, and where you are, is it conservative, moderate, aggressive. We'd love to have these conversations with you. Give us a call at 203-371-4242. That's 203-371-4242, and let us help you actually figure out the value of your portfolio and where you are. Is it kind of expensive, or actually what you own is kind of cheap? And where do you want to be? This is Bobby Walsh. Thank you very much for listening.